Good morning. It's Thursday, the 19th of September, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take. In a bull market, everything goes, including slapping the Prime Minister's name on a category of stocks as brokerage CLSA did ahead of the general elections that started in April and ended in June this year. I wondered then, as I still do, what was CLSA really thinking? As in, was this the outcome of serious research or a SEO-led clickbait option? Now, the stocks which the brokerage pulled together were mostly in the infrastructure space, benefiting from public spending, as well as stocks which were state-owned or public sector enterprises. Now, there's nothing wrong in that, except that the bet, even if it was only optical, was on the individual and politician magically pulling all these stocks to great heights in the future, like nothing else mattered. The problem now is the tide is turning. A report just out from Bloomberg says the index of the so-called Modi stocks, CLSA's term, has climbed only 2% as the Prime Minister completed his first 100 days in office after winning a third term in early June. In contrast, consumer and software stocks have rallied 20% and 34% respectively. So that would mean that not only was CLSA drinking the Kool-Aid that it was serving to the larger world, but was also missing the wood for the trees at the same time. Now, I have no way of knowing whether the brokerage also made money either way on these stocks, that's consumer and IT, and quite possibly it did. The administration is turning populist on the margin, another disappointed-sounding strategist at Jefferies Financial Group wrote in a note quoted by Bloomberg, adding that they expected the government could miss its target on capital spending. By the way, this is not to say the Modi stocks are not doing well. They are and are still on pace to outperform the country's main equity indices, that's the Nifty and the Sensex, for the fourth straight year. But the index of such stocks has rallied 24%, or rather had rallied 24% in the first 5 months of 2024, as the government prioritized building infrastructure capacity while retaining focus on driving efficiencies at the state-run or public sector enterprises, according to Bloomberg. But here's the other sign of a turning tide. Domestic mutual funds have apparently started cutting their exposure to companies making capital goods in each of the 3 months since the June 4th election result, according to a note by Motilal Oswal, also quoted by Bloomberg. And finally, foreign funds have also turned net sellers in sectors like utilities, cement, metals, and financials in August, according to a Bloomberg intelligence analysis. Now, there are a few points here. First, CLSA was of course not alone in pinning their hopes on individual politicians. Perhaps they were a little more clickbaity in their proposition. Second, while capital spend may slow down and be replaced by moves to uplift the bottom part of the population, including with expanded insurance schemes and other subsidies and benefits, there is nothing to say that capital spending will grind to a halt, quite the contrary. And perhaps a breather is a good idea. Third, there was nothing conceptually wrong in the government strategy as a strategy in putting their weight behind public expenditure to propel economic growth and prosperity. Now, no one is saying that this should be at the cost of public expenditure on education and health, for instance, but the larger question, how much and for how long? Maybe a 10-year or an 8 to 10-year solid run was good, and it was time to start moderating and balancing out. Now, whether that could have happened if the election results were different is anybody's guess. The final and renewed lessons is that stock markets are mercenary at the best of times and can change tunes overnight. Politicians also know this, but I feel sometimes they forget. Meanwhile, the stock markets continue to rise, and agree or not, the government of the day has the right to take some credit for it. But as always, some stocks are in favor and other stocks or sectors are not. And the current wave may be a little different from the last one. Perhaps CLSA will come up with a new term now, if not already. And that brings us to the top stories and themes for the day. The stock markets slip again in anticipation of moves from the Federal Reserve. India overtakes China on a key MSCI index. Why are India's exports slipping? Should you rent or buy?
This is the Core Report with Govindraj Ethiraj.
The markets slip and slide. The market slipped once again as they waited for global cues, notably an interest rate cut from the Federal Reserve in the United States, the size of which was anybody's guess overnight. While the markets might appear listless in many ways, I would still see that as a good sign, since rapid rises, or descents for that matter, are more worrying than gradual ups and downs as we've been seeing in recent weeks. Domestically, there are no major triggers on the horizon except the shifting that we can see between sectors, and some sectors clearly doing better than the others, and that has also changed as we just spoke about. The BSE Sensex and NSE Nifty once again hit record highs and then fell back into the red on Wednesday. The Sensex fell 131 points to settle at 82,948 after hitting a fresh high of 83,326 during intraday trade on Wednesday. The The Nifty also hit a record high of 25,482 before ending Wednesday's session at 25,377. That was down 41 points. India overtakes China on the MSCI. So India now has overtaken China for the first time ever in a key MSCI equities index. MSCI used to be called the Morgan Stanley Capital International Index. India's weight in that MSCI investable large, mid and small cap index has risen to 2.35%, greater than China's weight of 2.24%, Morgan Stanley said in a note on Tuesday, reported by Reuters. Morgan Stanley said that India would continue to gain share due to market outperformance, new issuances, and liquidity improvements. India's nominal GDP or gross domestic product growth rate is running in the low teens, more than thrice the economic growth in China, generating a profound divergence in earnings growth environment. Morgan Stanley said China's weight on that index had peaked in early 2021. Analysts also believe that India's rising weightage in that MSCI index will bring in additional inflows. So just to put things in a global context, India is or continues to be amongst the best performing markets, with the benchmark NSE Nifty and BSE Sensex up 17% and 15% respectively this year. On the other hand, China's Shanghai Composite Index is down about 9% amidst concerns over the economy and the property sector, which we will touch upon more in a moment. More rice curbs on exports to go. The government has embarked on several moves in the agricultural space, as we referred to yesterday as well. For instance, raising sharply import duties on edible oils to protect domestic farmers, and on the other hand, opening up exports for basmati rice and onions, for example, which were curbed last year or 2023. Rice is, by the way, looking at a very strong crop this year, and exports or opening up exports would obviously be a good idea. The government may now ease curbs on non-basmati rice exports, India's food secretary said on Wednesday, as rice inventories have jumped. Last week, as we said, the government removed a floor price for basmati rice exports, and Food Secretary Sanjeev Chopra told reporters the government was considering raising domestic sugar sale price and ethanol prices as well, according to Reuters. China's steel production is falling. China's steel production has now fallen by more than 10% from a year earlier in August, thanks to low prices and slowing demand. Many mills have shut furnaces in China as they face increasing losses with their production, according to Bloomberg, which also added that production of crude steel was down about 10.5% from a year earlier to about 78 million tons, according to the National Bureau of Statistics there. Now, that's apparently the weakest August for any year since 2017 and deepens the overall decline. Total volumes for the first 8 months of the year were about 3.5% lower at about 691 million tons. So the time frame is worth noting. China's steel demand is falling after more than 20 years of consistent growth, including thanks to urbanization and the construction boom. China's real estate sector is now badly hit and under pressure. Why are exports falling? India's merchandise exports, as we mentioned yesterday, contracted about 9.5% to about $35 billion in August, thanks to soft global demand and challenges posed by logistics. Imports, on the other hand, rose about 3.5% to about $64 billion, leading to a trade deficit of about 29.6 or close to $30 billion, a 10-month high. The high import numbers were driven by gold, whose imports were up about 3 times to more than $10 billion in August, thanks to rising demand and, of course, lower import duties. So what is happening with exports if we break it down, and what's the outlook ahead, more importantly? I reached out to Ajay Srivastava, founder of the Global Trade Research Initiative, a think tank focused on trade, and I began by asking him how he was seeing trade trends right now.
Yesterday, the data was released, and we searched for one key which explains most of the trends is this. Let's focus on petroleum exports from India. So the August data says that our merchandise exports are down by 9.33%. But if we discount the petroleum exports, the remaining exports are up by 0.5%. So the decline in petroleum exports is 37.5%. So petroleum is a substantial quantity exports for India, and its tangible decline in August by 37.5%. It pulls down the other categories. And so with petroleum, our merchandise exports are down by 9.3%. And without petroleum, they are down by just 0.5%. And the interesting thing about this is, petroleum prices, they're almost similar, almost same in August 24 and August 23, the two periods we are comparing. Why this is happening? So one explanation could be that, we export plenty of petroleum products to Europe. And because of Red Sea crisis, that ships are taking longer route via the Cape of Hope, that increase the freight. And the change which this is doing to our exports is that the low value and high volume exports, they may lose the competitiveness and ultimately they may lose the market. And I guess that's what is happening with the petroleum products. But this time, we are watching this trend and we should be careful in seeing this trend repeating itself in other sectors, which are other sectors where volumes are high but values are low. For all these, most of these leather intensive export sector, textiles, garments, leather, shoes, handicrafts, everything will come into these categories. And the next few months, we have to be watchful about these exports to basically Europe if this crisis persists. And I don't get any sense that the crisis is loosening anytime soon. So petroleum exports are down because of Red Sea crisis. And they are pulling the overall India's export trade data. Without petroleum exports, we are just doing fine.
Okay, so that's good to hear. Anything on the import side? I mean, clearly we've been importing a lot of gold.
So you must have seen that this budget government has reduced the import duties on gold and silver from 15 to 6% and on platinum to 5.5%. This was a demand for long, cut the duty from 15 to 12%, if not 12%, then 13%. But suddenly government had to cut duties from 15 to 6%. It's not out of any charity, but out of, I think, compulsion, because we negotiated India, UAE, FTA, and plenty of gold at concessional duty, gold and silver started coming from Dubai under that FTA. It was wreaking havoc on the gold and silver economy because in May this year, about 87% of silver came from Dubai and everything from Gift City route. So 15% for normal people, the import route for other countries, for UAE, it was 5% for gold and 8% for silver. So this was a big arbitrage, and about 8-9 firms, they took huge advantage of this. They set up their firms in Dubai and they started trading heavily. And to prevent that, I think government, it's not written anywhere, it's not talked anywhere, but my sense is that to prevent that, government was forced to bring down the duties from 15 to 6% on gold and silver. And the second step government took is duties are today 7-8% under UAE SEPA, but it's a progressive reduction, which means in 3-4 years' time, the duties on gold and silver will become zero under the FTA. And government cannot bring the duties at zero level because it will lead to rise in imports and forex issues, all these things. So government is talking to the UAE authorities for review of this India-UAE SEPA. So that what is the gold and silver story. But to answer to your question, we reduced the duties from 15 to 6%. It was a bonanza. People who were accustomed to higher duties of 15%, they thought this is the end of the world type of situation. And you can see the August figures, 104% jump compared to last August. And in silver, 727% jump compared to last August. And most of the imports earlier, they were coming from Dubai. But now, Department of Commerce has not released the product and country mix data. It's very broad data they release. So that data will be there after 2 months. Then we can talk more about that.
Right. So just to come back on exports, if you were to take away oil or other oil exports and petroleum product exports rather, and you said that the other sectors are doing all right, what's the outlook for the next 3 months or 3 to 6 months looking like, given everything else, including the challenges on the Red Sea?
To answer this, I want to look at how we have fared during April to August, because that trend may be replicating to a great extent. So during April to August, we see the positive export growth in pharmaceuticals, organic chemicals, engineering goods, Electronics, of course, is growing at a very steep pace of 22%, riding on the smartphone exports. And then on agriculture allied commodities, we see the exports of meat and spices rising, fruits and vegetables are rising, cereal preparations are rising. So all these exports, they account for about 60% of India's exports in merchandise, and they are rising. But I should also talk about the exports which are registering the negative growth. They are iron ore, leather, ceramics, gems and jewelry. And it's very strange when imports of gold and silver are rising, our exports are coming down. And of course, petroleum products that we discussed. In agriculture products, rice is down because, of course, we put the export restrictions. We now only removed it. Marine products are down. Oil meals are down. So this is the situation that about 60% exports are doing positive, 40% negative. And as World Bank, IMF, everybody is saying situation will be tough, but the world will be able to sail through efforts of China and India. They're naming two countries only. So let's keep our fingers crossed. Yeah.
Yeah, speaking of which, I mean, iron ore, I can expect or imagine because China is now producing less steel. They import most of our iron ore, and that will slow down. Why is leather slowing down?
Going my sense, I have been studying this textile and leather sector for the past at least 3 months very deeply to understand why we are not doing well. So we release a report on textiles, not on leather right now. And we, in my sense, I should be talking about textiles, not about leather, because I should not generalize it. Many of our own acts of commissions, they're holding the progress of the sector. We talked about those issues in detail. For example, 70% of the garments sold in the international markets, they are synthetics, non-cotton. Our share in those fast fashion garments or sports garments is very less. Why? Because we are not competitive in making synthetic. Bangladesh also is not. So they allow free imports. But when we allow imports, we put 1,000 conditions, which is stifle. I mean, my heart cried when I looked at the specific conditions, how you have to match centimeter by centimeter, hook by hook, chain by chain. That's how the customs conditions, DGFT conditions. So they have to be looked de novo to set these sectors free. Of course, there is a competition from low-cost countries like Bangladesh, Cambodia, Vietnam, all those. But what we don't discuss is our act of commission. We should focus more. They are in our control. And the earlier we knock them out, the better for the sectors.
Mr. Srivastava, thank you so much for joining me.
Thank you very much. Thank you.
Should you rent or buy? A new report from Anorak Research, a consulting firm, says that rental values in key micro markets of the top 7 cities in India have gone up to a significant 72% in the last 3 years, while capital values saw lower growth. So which means that for the house you owned, if you did, you could have been earning higher rents while the price of the house itself would not have appreciated that much. Which seems fine, and the higher rents also followed the post-COVID return to base, whichever that base was for you. Bangalore, Pune, Kolkata and Chennai saw rentals rise more than the capital values, said Anorak Research, that real estate consulting firm. Bangalore Sarjapur Road, for example, saw monthly rentals rise 67% in this period, while capital values rose 54%. There are many more other markets where, of course, the values have risen less. On the other hand, micro markets in National Capital Region, that's around Delhi, Mumbai Metropolitan Region, that's around Mumbai and Hyderabad, saw capital values appreciate more than rental values. So the moral of the story, if there is one, is that one should look at a 10-year period and then see what you would have paid out in rent versus buying the same house now. So if you rent it, then the outgo could be almost 70% of the value of that house, according to one calculation by Anorak. Instead, if you finance the same house with a loan which you could get, let's say, at a 9.5% interest rate and pay out the installments over the same 10 years, after putting, of course, 20% down, so effectively you're paying for 80%, it might work out better. And of course, you would have the proverbial roof over your head. But then, would we know where we could be in 10 years' time, as in which city and doing what? I guess it's a tough one, and that's where the matter of rent versus buy becomes tricky. No one said that this was an easy debate. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.